Todd Combs is best known as one of the two money managers working under Warren Buffett at Berkshire Hathaway. He and Ted Weschler at this stage manage about a $30 billion portfolio, and the two of them are very likely to take over the management of Berkshire's stock portfolio after Warren Buffett's no longer at the helm. And Ted and Todd very rarely make public appearances, and there's not a lot out there on how the two of them think about making investments. But luckily for us, Todd Combs recently was a guest speaker at the Graham and Dodd annual breakfast at Columbia Business School, and he shared a range of thoughts on how he and Warren Buffett think about picking individual businesses. The conversation spanned quite a wide range of topics, including finding good businesses, how he and Buffett filter out different stock ideas, some thoughts on valuation, how he spends his time at Berkshire, especially considering he's been the CEO of GEICO since 2019, and also some stories about some of the regular meetings that he and Buffett have on Saturday afternoons at Warren Buffett's house. So in this video, I want to cover some of my highlights from what Todd Combs actually said at that event, and I have to give a massive shout out here to a Substack newsletter called Investment Management Insights. They did a full write-up of everything kind of Todd Combs said at this breakfast, and that's where I'm sourcing a lot of these quotes and things from. So if you want to read that full Substack article, I'll leave that link down in the description as well. So that is the plan for this video, but before we get into it, we do have a sponsor for today's video, and this one is sponsored by Hatch. Hatch is the platform I personally use for all of my US investing for me as a Kiwi based here in New Zealand, and Hatch is asking you to think about what your big and small tomorrow goals look like. For me, the goal has always been financial freedom, putting a little bit away today with the aim being that I can do the things that I want to do tomorrow. Everyone's tomorrow looks different, whether you want to buy your ultimate dream car, travel the world, or become financially independent. Reaching your goals starts by taking the first step. That's why I invest with Hatch to help make my plans a reality, and if you want to get started investing with Hatch, check out the first link in the description below, where you can get a free $20 New Zealand dollar top-up when you make your first deposit of $100 New Zealand dollars or more before the 31st of December 2022. Now, one of the first things that Todd Combs shared in this breakfast is that good investing is simple but not easy. You know, Warren Buffett wants to buy simple, predictable businesses that are easy to understand and that have wide moats and durable competitive advantages. And that idea is reasonably straightforward, but actually finding that in practice and having confidence in your assessment of different businesses is actually quite a challenging exercise oftentimes. And Todd Combs shared that one of the first times he ever met Charlie Munger asked him what percentage of companies in the S&P 500 will be better businesses in 5 years, and Todd Combs guessed that it's probably less than 5% of companies in the S&P 500. Munger thought it was actually less than 2%. He said rate of change is increasing, and basically that Charlie and Warren are actually becoming probably decreasingly confident in their ability to predict the future. When Todd Combs started at Berkshire, he said they had about a 7 out of 10 confidence on business outlook over the next 5 years, and he said things are changing so rapidly these days that he says that they might be right in maybe 1 out of 10 predictions. Now, it was really interesting to hear from Todd Combs some insights on basically what he and Ted Weschler and Buffett and Munger actually spend their time talking about and thinking about. And he said one question that's constantly asked, usually daily, and that's about whether the moat is getting wider or narrower on any of their businesses. Presumably, this is usually talking about their public holdings, but of course it's relevant to the wholly owned subsidiaries at Berkshire as well. And he said 98% of what he and Warren Buffett discuss is qualitative. If something is 30 times earnings, you can calculate what it'll have to do to get to run rate earnings. The worst business grows and needs infinite capital with declining returns. The best business grows exponentially with no capital. And there's quite a bit of qualitative assessment that goes into some of those conversations. And although if something trades at a certain earnings multiple, there's a lot of basic arithmetic you can go through about what earnings are going to need to be for that valuation to make sense and for you to get a good return. There's a lot of qualitative assessment that goes into the long-term growth and competitive advantages of the business. Now, I think one of the most fascinating things that Todd Combs actually shared at this breakfast is sort of the litmus test for how Warren Buffett filters down companies and gets kind of a short list of things that he might be interested in investing in. He said that he often goes to Warren Buffett's house on a Sunday afternoon and they kind of just talk business and investing. And Buffett has said to him, how many names in the S&P are going to be at 15 times earnings in the next 12 months? How many of those are going to earn more in 5 years than they are today with a 90% confidence interval? And how many will compound at 7% a year using a 50% confidence interval? Combs kind of described that by going through this exercise, you're solving for a range of things and eliminating a lot of businesses very quickly. He said you're solving for cyclicality, compounding, and initial price. And Todd Combs actually explained that this is one of the reasons that they found Apple a few years ago. They were going through this process and the same 3 to 5 companies kind of just kept coming up over and over again, and Apple was one of those businesses. To me, this is really interesting because I've heard Buffett talk for years at this point about kind of the concepts behind valuation. It's the whole a bird in the hand is worth two in the bush, and how sure are you, that kind of idea that Buffett has talked about for a long period of time. But I've never seen sort of quantitative metrics put behind it. And to see this idea of, 15 times earnings, and are they going to earn more in 5 years with a very high degree of confidence and slightly lower kind of confidence intervals around how long they can compound at a certain rate, to have some quantitative data behind how Buffett thinks about that to kind of weed out a lot of stocks that he isn't necessarily interested in. That for me is a pretty huge insight. Next, Todd Combs talked quite a bit about company management and how he goes about assessing management teams and so on, and some of the ways that he and Buffett think about company management and capital allocation. He said, businesses are run by people. Buffett likes removing the cash from managers and investing it himself. My interpretation of that is that's probably one of the reasons that Buffett is such a fan of share buybacks, as opposed to CEOs going out and doing big acquisitions and so on. He also said that, as we've heard many times before, he's looking for a business that a dummy can run because eventually a dummy will run it. And there's a very old school Charlie Munger idea about focusing on CEO incentives, and that can tell you a huge amount. And there's a couple of things that Todd Combs had to say on that. Todd Combs said if he was 150% dedicated just to analysing companies, he'd focus on Delta reports and see what management is changing from year to year. He said in 2005, Bear Stearns, which obviously ended up going bankrupt in the global financial crisis, he said Bear Stearns changed something very essential in their reports while saying something different to the street, or saying something different to investors and analysts. The article goes on to say that a big signaling effect for Combs is when management changes the key performance indicators for which they are compensated by. That's kind of a major red flag for Todd Combs. And Combs estimated that in the Fortune 500, approximately 20% of companies are changing incentive metrics for management, and that's not an accident. Again, to get a really good feel for how management are thinking about running the business and their underlying incentives, Todd Combs said that if he ever talks with company management, he basically asks them 2 questions. Firstly, he says, how long do you spend talking to investors? And secondly, he says, what would you be doing if you were not publicly traded, if you were a privately owned business, for example? He said the median response is about 25% of time is spent talking to investors. And in response to the second question about what would they be doing differently if they were a private company, he said that generally management teams list off a few things that make a whole lot of sense, and then Combs proceeds to ask them why they don't do that, and they say because they feel handcuffed. They're forced oftentimes to focus on quarterly performance. They don't think they have the proper time horizons. They're not empowered to do the right thing. And that's a really good example of, again, things that you would not like to see. Berkshire Hathaway, for example, does not care about quarterly performance at all. They care about long-term performance. They spend 0 time talking to analysts. They have, letters and annual reports and stuff that come out, and they have the annual meeting, but they don't, spend day-to-day time kind of talking to analysts. And that's a common theme I've actually seen through a few companies now over time that have successful track records. Todd Combs spent quite a bit of time talking about how he thinks about valuation and owner earnings for companies. So he says that you should focus on basically two things. You should focus on unit economics and the underlying business, and you should focus on owner earnings as opposed to reported, generally accepted accounting principles earnings. He gave the example of Berkshire Hathaway, which, each quarter has to market their stock portfolio that flows through the income statement. So in a quarter where the stock market simply goes up a lot, Berkshire's earnings can look really good, and that is obviously not kind of a true reflection of the underlying operating businesses. So you really have to focus on the underlying earnings for a kind of true owner of that business, how much cash could be extracted from the business after, maintenance, capital expenditures, and so on. So that's one thing he pays a lot of attention to. And the other thing, like I said, was unit economics, and that can change quite a bit from business to business. So he said, for example, you can have a software as a service business incurring 100 cents on the dollar in expenses on day one, and going forward earn whatever the lifetime value of the customer is. So you have to have a view where you can understand what the financial image looks like. For example, in the early days of Walmart and Amazon, I wouldn't focus on the fact that the reserves seem wrong and quite large. Look at where it took them. I build out unit growth economics. In the case of Walmart, look at each individual store, and that's your North Star. You backtrack and you get to customer acquisition cost, lifetime value, and so on. He gave even more information on this with GEICO as an example. He said, first figure out the customer acquisition cost and lifetime value for GEICO. You know the data of where they live and their kind of car, and then there is the lifetime value of the customer. He said that he thinks where people go wrong is they think they know their customer acquisition cost and their lifetime value, but it's from too high a level. When you slice the data, there are really big pockets where the lifetime value is negative, and that's where the potential is to really improve margins. Again, another example he gave on that same topic was the shed light on this can be in a large bank where the overall return on assets can be great, but within that you have pockets of high and low return on assets. So it's important to break down and segregate to see the actual unit economics. And again, kind of pressed a little on valuation. He basically said after figuring out the unit economics and the owner earnings, the first thing Todd Combs does is simply just look at the PE, once he feels like he's got a good understanding for the business. Now, in the past kind of 3 years, the role, I think, at Berkshire for Todd Combs has changed quite a bit. So he used to be one of the two money managers at Berkshire, him and Ted Weschler. He still is one of those two money managers, but his main kind of time spent has actually been the CEO of GEICO these days. He's been the CEO since 2019, and I believe he took over Lou Simpson's portfolio, who had a very successful track record of running money kind of at GEICO for a long time under the Berkshire umbrella for quite a period of that also. And this is basically what Todd Combs said about the differences between being an investor and being a manager now at GEICO, and some of the overlaps between those two slightly different roles. And he also shared a little bit about what his kind of time allocation now looks like at Berkshire. How much does he spend on investing versus what he spends, in the GEICO business day to day. I will put on the screen here the 10 kind of areas of overlap that Todd Combs laid out between investing and management. I won't read out all of them, but to pick on a couple, he highlighted you have to have intellectual honesty. That's a major overlap. Focusing on facts and numbers versus narratives. Due diligence, and apparently Combs loves these skip level meetings where instead of going one level down from the CEO, for example, he skips like 3 to 7 levels in the hierarchy and tries to figure out what's really going on. And he tries to find areas where you can push a little and change a lot. He said you want nuclear fusion, put in 100 units and get out 1,000 or 1 million. And like I say, in terms of time management for Todd Combs, things have changed quite a bit versus just a few years ago. So he said he basically has a couple of jobs. He said in terms of time allocation, somewhere between 100 and 110% of his time is spent on GEICO. He's doing 16-hour days there, and he does his investing at night and weekends, which makes up approximately 25%. And then he said finally bank board meetings are the other 25%. So by my maths, that adds up to somewhere between 150 and 160% of his day. So interpret that as you wish. I think Todd Combs is working a lot. And for anyone that's unfamiliar, that bank board meeting component is referring to JP Morgan. Todd Combs is a board member on the JP Morgan board. Now, the final thing I want to mention here that came up quite a few times throughout the breakfast, in some of the prepared questions and also in some of the Q&A, kind of audience Q&A that happened towards the end, something that came up over and over again is that basically Todd Combs and Warren Buffett don't spend a lot of time trying to predict macro, trying to predict inflation numbers or what interest rates are going to be a few years out from today, which a lot of people do spend quite a bit of time on, I would say. He said that he and Warren were talking for hours this past Saturday, and they didn't talk about inflation for more than 30 seconds. So that hopefully gives you a bit of a feel for that. He did say, however, that they always try to consider different economic circumstances when they look at a particular business. So they don't try and predict what inflation or deflation or whatever is going to be, but they certainly think about how that might impact each business. So he said in a deflationary environment, they would ask themselves how the business would perform with 10% inflation. He said, never just extrapolate the current environment state. Cyclicals always look expensive at the bottom and cheap at the top. Always invert. So those are a few of my highlights from the Substack article covering this recent breakfast that Todd Combs spoke at. Like I say, I will leave the full article link down in the description below. It's one of the best things I think I've read this year in terms of getting some new insights about how the people at Berkshire Hathaway think about making long-term investments. So hope you enjoyed the video. If you did, please subscribe. That way you can catch future content here on the channel as soon as I upload it. But that's it from me for this one, and I'll see you in the next video. Cheers.